Why boom and crash traders wash their accounts. Boom and crash indices are fun pairs to trade, especially if you want to grow your trading account significantly over a short period of time. You need to catch a few spikes accurately with a decent lot size and take your day off. Why do a lot of boom and crash traders wash their trading accounts? What is the recipe to do good in the boom and crash market? In this video, I will answer these and a lot of other related mistakes that lead to blowing up trading accounts. Why do boom and crash traders blow up their accounts? Boom and crash traders simply blow up their accounts by underestimating the power of discipline and money management. Specifically, minor mistakes such as using full margin, removing or extending stop loss, revenge trading, etc., are the main reasons that can wash a boom and crash trading account no matter how big your equity is. Trading is no different than any other business, and it requires a good understanding of the market, mastering the art of technical analysis, controlling your emotions, accepting the reality whether you like it or not, and a lot more to become a consistently profitable trader in the long run. Being part of different trading communities, I hear most of the folks talking about the boom and crash as if these indices are comparatively easy to trade than other forex pairs. Despite not having any fundamentals, these indices are way more volatile than any other pairs that you may have traded before. Here is why. On a normal day, you can expect 300 to 500 pips movement in the boom and crash indices, and holding one wrong trade can result in severe reduction in your equity. Another reason is the spike itself. If you are someone who trade against the spikes just to catch some 5 pips, a single series of spikes is enough to take back 5 times more. That being said, it is extremely important to learn each and everything before you go and try your luck in the boom and crash market. To learn the right way to trade the boom and crash, let me first explain the wrong approaches that lead to blowing up an account. Poor lot size selection. Neither a big nor a small lot size is a poor lot size. A poor lot size is one that does not suit your equity and risk-reward ratio. For example, if you have a $100 boom and crash account and you use one lot size, that would mean for every 1 pip opposite movement, you lose $1, and let's say you are stopped at 20 pips, which is $20. 20% of your entire equity in a single trade. It will take only 4 more failures to kick you out completely from the market. Never do that. Trade with an equity-friendly lot size. Well, there are no hard and fast rules for that, but for accounts below $100, don't use more than 0.20 lot size and try to slowly and gradually grow your account. Once you see the blues coming your way, you can start using 0.2 plus lot size. You should also consider the winning chances of the trade while selecting a lot size. If you see a strong evidence in the price, there is no harm to go big keeping a tight stop loss. Here is my article on boom and crash trading strategies that explains when to go big. Risk-reward ratio. Do you place a trade and decide afterward whether the trade was worth taking? If you do, you are doing it completely wrong. Before you place a trade in the boom and crash, take your time and analyze the trend in different timeframes. Decide what % of your equity would you risk and how much you expect from the trade. If a trade requires you to risk more than the reward, it is simply not worth it. Again, there are no hard fast rules, but you should always go for higher rewards. A risk-reward ratio of 1 to 2 plus is ideal, which means that for every $1 you risk, your reward, take profit, should be at least $2. It will help you grow your account in the long run, and this way, you will avoid losing too much in a single trade. Playing rough with stop loss. This one inherently lies in beginner traders and has, at some point, served as a nightmare for most of the traders out there, including me. Playing rough with stop loss means that you either remove stop loss to avoid the $10 loss, that ultimately blows your $100 account, or place it a bit farther because you think you have found some new evidence. Whenever you place an order, decide where you want to keep your stop loss. Whether you keep it according to your equity, trading style, or strategy, there shouldn't be any second thoughts once you place it. Not making charts. It happens most in the boom and crash market. When traders catch a few spikes using a certain strategy, it makes them overconfident about the strategy, and they stop relying on charts. Of course, you can follow others' charts and avoid the heck of charting, but every trader has his own psyche and understanding of the market, and following something that you are not sure about can cost you a fat share of your equity. Not analyzing the market at full potential before taking a trade is one of the primary reasons why most boom and crash traders get their accounts washed. Trading with minimum equity. Since the minimum equity requirement of DARA is $10, most boom and crash traders start with lower equity to avoid losing a lot of money. The reality is that while you may win at times, but considering the volatility and stop loss hunting, you will most likely blow your boom and crash account by trading with equity lower than $500. Do not simply trade the boom and crash pairs if your equity is lower than $500. Instead, trade other humble pairs like Step Index and Volatility 25 with minimum lot size. Once you grow your account to the recommended minimum, it's about time you catch spikes. So, how not to blow up my boom and crash account? To give you a one-liner, trade with discipline. Here is what it means. If you want to become a consistently profitable boom and crash trader without blowing up your account, you must adopt a disciplined trading approach. A disciplined trader is one who believes in reality instead of assumptions that are based on emotions. Before you place your trade, make sure you have your own chart or a chart that you fully understand, and you are clear about your entry point, stop loss, and take profit levels. In addition, you should use an equity-friendly lot size and a decent risk-reward ratio. If you follow these codes, there is no reason you won't become a consistent and profitable trader in the long run. Simple as that. Final words. Many boom and crash traders blow up their accounts mainly due to using a poor risk-reward ratio, extending or removing stop loss, not analyzing the market or not having a chart of their own, using bigger lot sizes, and trading with minimum equity. In essence, traders who are new to the boom and crash market make these mistakes and end up blowing up their accounts just to learn it the hard way. The boom and crash indices are no different than normal forex pairs, and the only two differences that I can come up with are lack of fundamentals and its synthetic nature. Synthetic means they are computer-generated numbers and are not backed by any organization, country, or individual. Therefore, do not kid around these indices. They are extremely volatile and can give you nightmares worse than any forex pair that you can come up with. Best of luck with your next trading session.